Welcome to today's event, Managing Wealth Through a Pandemic, Insights from the Frontline, hosted by CFA Society Chicago's CFA Women's Network. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you would like to ask a question, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Elizabeth Martinez, CFA, Senior Vice President and Portfolio Manager at Bank of America Private Bank. Beth works closely with high and ultra-high net worth clients to develop and implement tailored investment initiatives. She is adept in diverse asset classes, including traditional and alternative investments, such as private equity, hedge funds, and private markets. Joining Beth for today's discussion are Jenifer Aronson, CFA, Managing Partner of Mosaic Fi, LLC, and Sunitha Thomas, CFA, a Senior Vice President and Regional Portfolio Advisor in the Wealth Management Business Unit at Northern Trust. I will now turn it to our moderator, Beth Martinez.
Good afternoon, everyone, and welcome. Special thank you to our board members, Jenifer Aronson and Sunitha. I think she's joining us here just shortly. We'll get to see her in a moment. Terrific.
Hi.
How are you?
Good.
Great, great. Well, so here we are. Welcome to everybody. And so, boy, the past couple of months have been extraordinary as we've coped with the COVID-19 health crisis, the economic shutdown, and then its impact on financial markets. And so we have a lot to talk about today on how you've both been managing and working with your clients. And I know that our viewers are very interested in what hearing what you have to say. So Jenifer, maybe we can start off with you. Sure. As a managing partner for a registered investment advisory firm. Could you provide us with the breakdown of the types of clients that you work with and your investment approach during this period of extreme volatility and uncertainty?
Sure. So we work with individuals and families. In some cases, we work with multi-generational families. So we'll start with a client and they might ask us to help them work with their elderly parent situations. And more recently, we've begun working with some adult children of clients that are just starting out in their careers and need some financial guidance. We do have a large niche working with women. So women who have either have been widowed, divorced, perhaps going through a divorce and helping them through that process. We also work with small businesses, and that can be anywhere from 1 to 25 employees. So we work with sole proprietors that may be consultants of some sort or professionals up to small businesses that have several employees. In terms of our investment philosophy, we very much believe in starting with the financial planning. So understanding a client situation in its entirety, what their risk profile is, what their objectives and goals are, where they are today and where they would ultimately like to be. Once we've gone through that process, that sort of leads us to what the appropriate investment strategy is and the appropriate asset allocation. So once we have implemented that asset allocation, it becomes about rebalancing client portfolios as markets move. So we set targets, we set ranges around those targets, And as markets move, we will adjust accordingly. So we believe that that is what takes the emotion out of buying when asset classes are going down and selling when asset classes are going up. Never an easy thing to do when there's emotion involved in that. Our commitment to this strategy was certainly put to the test through this crisis. So in March, we were watching as the stock markets were plunging, we were watching our equity exposure move to an underweight and our bond exposure move to an overweight. And so staying true to this approach actually allowed us to buy some equity exposure in our client portfolios on March 17th. Which, while not quite the bottom, came pretty close, which was on March 23rd.
Yeah, well, not easy to do during.
No,
absolutely,
it wasn't.
Sunitha, and you're a regional portfolio advisor for one of the largest banks in the United States. And so could you share, do you work with, similar type of clients? And also if you could share your investment approach over the past few months or even over the long term.
Absolutely. Well, thank you for having me, Beth. So I work primarily with ultra high net worth business owners and multi-generational families. And our approach, similar to Jenifer's, is really when we work with clients, we always advise them it's better to be prepared than try to predict every single market environment. So over the last year, especially as the market was going up, we reviewed with all of our clients whether their portfolio was the right one to be able to meet their goals and also the level of protection that they had against volatility. The approach that we use to do this is called goals-driven wealth management. And that approach really starts with understanding a client's whole balance sheet, so all of their liquid and non-liquid assets, understanding and quantifying the goals that are aligned against that balance sheet. And really the core is we believe that these portfolios and balance sheets are going to have a purpose, whether it's in this generation or beyond. So better understanding that can help us be more intentional about building portfolios. Each goal has its own asset allocation. So anything that's in the near term is going to have more fixed income. Anything that's in the long term is going to have more equity. And it also has a custom risk measure that aligns, that really protects a number of years of core lifestyle spending against market volatility. And the way we inform that is we look at multiple market events. So for years, I've been talking to my clients about, oh, well, if the Great Depression happened again, it would take 20 years before prices reverted to their original prices, whereas the Great Financial Crisis was 13 years. So we've been talking about market events like this for a while. So it really helped when we actually got to a market event like this, that clients knew, the purpose of their risk assets is really for growth and for long-term growth, and then the protection they had against market volatility.
Great. Planning is key for sure.
Yes.
Yeah. Jenifer, what are your recommendations for current allocations? Do you prefer a certain asset class or market cap or kind of a style tilt to client portfolios?
Sure. So while we are not market timers and don't, tactically move our client portfolios around, given short-term views, we do have had a strategic overweight to U.S. equities. We tend on the fixed income side, we believe that fixed income is a marathon, not a sprint. So being able to out yield with less risk is usually a winning strategy. In the fixed income markets, that was put to the test over the last few months, with a lot of volatility actually going on in the fixed income markets, a little bit behind the scenes from the average investor, not really realizing structural risks that were out there that the Federal Reserve came in and sort of saved the day rather quickly. But we do have some views. It will be interesting to see how things play out from this crisis. We've gone through a decade of the US markets outperforming international, but we are concerned that the US is a little behind Europe in terms of, first of all, they are beginning to move out of their shelter in place before we are, and they've also done a better job in terms of they don't have the unemployment situation that the US is dealing with. They've been able to keep their employees and companies together. So that could be a dynamic that that might create a shift in what we've been experiencing, where the US has really significantly outperformed a lot of the other developed markets. We also are watching small caps relative to large caps, which have underperformed, and in a recession, typically small caps do underperform. But I think we can all agree that the disruption that's going on in the economy right now will create a lot of interesting opportunities, and small caps might be better positioned to take advantage of some of the disruptions than large caps. So we're really interested to see how those things play out. On the fixed income side, the past year or so has definitely been about duration and government bonds. This next year, we have had a lot of disruptions in the fixed income markets. I think there's a lot of interesting, there will be a lot of interesting opportunities once the dust settles in the spread sectors of the fixed income markets.
Mm-hmm. Yeah, interesting. And even with municipal bonds.
Yeah, that too.
Mm-hmm. Sunitha, what are your thoughts on alternative investments? Is now a good time to add to the portfolio? And which particular AI strategy would you recommend? Long, short, market neutral, private equity, or hedge funds? What are your thoughts for that space?
It's a great question, Beth. And I think when we approach building client portfolios, we always start with getting tax-aware, cost-effective exposure to just stock and bond market. So that's the foundation of a client's portfolio. And then we look for unique sources of return that add return and also diversification. And alternatives are right in that category. Hedge funds that offer different sources of return than what clients get in their equity and bond portfolios, and that are not correlated, are a core part of our allocation. And that's been something hedge funds have underperformed, kind of a long only beta market for a while, but they really proved their worth over the last quarter. So that's definitely an area where we've always recommended a strategic allocation. And then private equity offers that illiquidity premium. It offers, especially as over the last 20 years, when there are half the listed stocks as there used to be, and a lot more companies are staying private. A lot more of the growth companies and technology and healthcare are staying private. So we do recommend having an allocation to private equity, also understanding a client's liquidity needs. Currently, one of the areas that I've been talking to my clients about is the private equity secondaries market. So that's an area where, especially after 2008-9, when there was illiquidity and people needed liquidity, then they would sell off their private equity portfolios at a discount. The market has evolved a lot since then, that now actually a lot more of those investments are going into preferred credit or preferred equity investments into companies. And also, there's just a lot of people who are looking for liquidity right now that private equity can fill. So in all cases, though, with on the private equity side, most of our managers are saying there's time and no reason to rush.
Right. Good advice there. Sunitha, what are your predictions in the near term and the path to recovery here over the next few weeks or months?
Yeah, so we're looking at this in a couple ways. So starting with containment of the virus, that's the first phase. Secondly, the economic impact and the policy response. And then thirdly, the slow reopening of the economy and therapies and vaccines. And in terms of containment, the market really bottomed around when infection rates were peaking in Italy and in Western Europe. Soon after that, you saw the peak in infection rates in the US, primarily driven by New York. And at the same time, you saw the government mount a very large fiscal and monetary response. And it really allowed investors to look through the economic valley of the second quarter. And it is a true valley. We've never had a cessation of all economic activity almost around the world. So that fiscal and monetary support was really important, but it also was significant in size and scope that investors were able to do that. Now we're looking at that slow reopening of the economy and how that's going to happen. There has been encouraging news on therapies and vaccines, probably more than we would have expected at this stage. Both, you just had Pfizer yesterday saying that they are starting human trials shortly. Gilead and Regeneron, the actual trials on their therapies are starting to be released, and we expect a lot more of those to be released in the next couple months. Now the market has rebounded 35% since the bottom, and really based on all of those factors. And at this point going forward, we really believe that the market's going to look at the economic fundamentals related to that reopening to measure whether it really is going to be a U, and if they can look to 2021 earnings. So our view is that the peaking in infection rates, the slow reopening, the fiscal stimulus that we believe will continue as long as it needs to, is going to lead to a slow economic recovery into next year.
Interesting. Jenifer, have you noticed a difference in investing related behavior among genders and age groups of clients that you're working with?
Yeah, it's actually been part surprising and some not surprising. I would say in terms of gender, I think men tend to watch what's going on in their portfolios a lot more closely and reacting to the day-to-day noise, where many of my women clients just are telling me, you know what, I'm just not opening my statements. I used to check my accounts, once a week, and I'm just not going to make myself crazy with it. And I think part of that is just a commitment to, we've worked on preparing for something like this, and so I'm just going to let it play out. Where I think, as a general rule, men tend to want to just focus on the day-to-day noise and stress themselves out about it. I would say it's been interesting on the age, the different age groups of clients that we work with, where you would think some of the older clients would be more concerned and reactionary to the volatility. And I don't know if it's that, they've been through this 10, 11 years ago. They know how this story typically will play itself out, where the younger clients, where they might have had a little bit of investment exposure in 2008, 2009, it was, they were pretty young in their careers. So this is really sort of the first time they've seen their portfolios take a significant hit, at least short term. So surprisingly, the younger generation, as a general rule, has reacted a little more nervously than the older clients.
Mm-hmm. Interesting. Yeah, they haven't been through that before, right?
Exactly.
Kind of an eye shot.
And I do think that has helped that we are only 11 years from the financial crisis. So again, and at the end of that, we began an 11-year bull market. So I do think that has helped a lot of investors, a lot of clients to feel a little more settled in the environment we're dealing with right now.
Sunitha, any sense of the kind of long-term impacts that the current crisis will have on investor behavior going forward?
So I think a lot of the lessons are similar to lessons that we've learned in the past, that asset allocation is really, really important and markets are volatile. Equity markets are volatile. We've had such a long period of low volatility. I think that that people were lulled into a sense of that there isn't volatility in the market. So we've learned it in the past. I think it was just another reminder that asset allocation is really important. I think to Jenifer's point as well, the role of fixed income in your portfolio, that you really, if the role of fixed income in your portfolio is protection, that you want to make sure it is high quality, liquid fixed income available if you need it when there is market volatility.
Yeah. Jenifer, have you implemented specific financial planning or estate planning strategies during this time? And
yes, we have. Many clients are sort of focused on just sort of what's going on in their personal lives. I think this is the first time where you've had it's the first time for most of us that you've had a complete economic shutdown and our personal lives so significantly impacted by what's going on that what's going on in their investment portfolios while they're concerned. First and foremost is the what's going on in their lives and their family and friends' lives. But I would say we've definitely taken advantage of tax loss harvesting. So taking the opportunity to move out of positions that we were considering or paring back on positions, creating that loss and moving that those funds into other positions that we thought would be a slower process, but this opportunity presented itself. In terms of estate planning, there's definitely been an increase in client focus on making sure that they have all of their estate planning documents in order and updated. And so we've been working with some clients to make sure that process has been completed. In terms of gifting, if a client has a donor advised fund, right now is probably not the best time to be transferring assets. So we've actually held off on making those moves for clients to see how things play out later on in the year. I have made recommendations for clients that want to contribute to their adult children or children that are working age, Roth IRA accounts, making contributions into those accounts so that they can get those funds invested. So those are some of the financial planning, estate planning opportunities we've tried to take advantage of.
Great. Sunitha, what is the number one question that your clients are asking you right now?
So I think on the way down, the number one question is why are markets going down so fast? But more recently, it has been why are markets going up so fast when the economic damage is still mainly in front of us? And my response is that stocks are the discounted value of future cash flows. And so if, with especially this huge monetary and fiscal stimulus, if it can be determined that is an event versus a structural problem in the economy, then the market will quickly look to what are normalized earnings to really value stocks. So the market really moved on the fact that they could see that path to recovery.
Jenifer, how about you? What is the number one question your clients are asking right now?
Well, I would say in the month of March, the question was, you know, are we rebalancing? Are we taking advantage of, you know, the downturn in the markets? I would agree with Sunitha that, you know, now the question is why, you know, why are we hearing all these horrible economic numbers and yet the stock market continues to rally? And you know, we could come up with a variety of explanations, but you know, my response to that is sort of the opportunity to reinforce the commitment that we have of getting invested and staying invested, because we really, there's typically not an exact correlation between what is going on in the economy versus what's going on in the stock market. So even if you had a crystal ball to predict how the economy was going to behave in the short term, that wouldn't necessarily translate into your ability to figure out how the stock market was going to react. And so, so that's usually my response to why is the stock market going up when all we hear are these horrible numbers.
Mm-hmm. Right, right. Jenifer, what do you advise the average investor in this environment? For example, you know, what should clients or people, individuals be doing with their 401k, investments, cash reserves? What are your thoughts there?
Yeah, so I think it depends on what the client's particular or the investor's particular situation is. So if they're extremely nervous and risk averse, feeling very risk averse right now, I would suggest there are a few things you can do aside from, or to keep you away from wanting to move your 401k into cash, to minimize, you know, any more downturn in the stock market. I would suggest in that situation you can, you know, turn off your reinvestment options of any income that gets generated from your investment portfolio. So any dividends or interest that get distributed can move to cash. Or along the same lines, you can continue your contributions, but maybe have those contributions go into your money market fund in your 401k versus your current investment options. Now, that's not the ideal strategy and approach to take, but that's for somebody who's feeling really nervous about what's going on right now and sort of foresees, you know, ugly days ahead. For people who are near retirement or not in an income producing period of time that are getting nervous about their cash reserves, I suggest reviewing their budget and really looking at what their cash reserve actually is, because chances are your budget is not nearly what you thought it was going to be, you know, 6 months ago or 3 months ago. You know, your travel budget is probably down significantly. Your eating out budget and entertainment budget is down. Maybe helping the kids out budget has gone up. But chances are you're going to be spending a lot less over the next 9 months or so than you were anticipating. And I think going through that process would be a little more comforting to really understand what your situation looks like. If you still feel like you need to raise some cash, then, you know, look to your fixed income portfolio. Again, at least some of your bond exposure should have appreciated in this environment. And so that would be a good place to try to raise some cash if you're feeling like, you know, you really need to create more of a cushion for yourself. And then if you can be opportunistic, considering a Roth conversion, whether it's being able to put off your RMDs if you're in the, you know, 72 or older, instead of taking the RMDs, you know, move it into a Roth IRA. Or if, you know, you're younger than that and want want to move some of your IRA or 401k funds into a Roth, that's a more opportunistic option. And then, of course, if you do have cash sitting on the sidelines, come up with a strategy of dollar cost averaging into the market, pick a day of the month, a certain dollar amount, and start putting some funds into the market.
Mm-hmm, mm-hmm. Yeah. Jenifer, at the beginning, and you had shared with us that you work closely with business owners and small business owners. Have your clients asked for advice for applying for unemployment insurance or government funding, such as the payroll protection program? And if so, what has that experience been like for you?
Yeah, so I would say that more than that clients have been asking for advice, I've been trying to kind of ram it down their throat. So we've been trying to push out a lot of information, or whatever information is available, and whatever research that we can do to create the awareness of what the options really have been to segments of the market that prior to this have never had access to any relief options. And so we've actually been, like I said, putting out information, calling clients and letting them know. It's been an overwhelming amount of information that a lot of people just figure it doesn't apply to me, or I just can't read through all of the, the information that's being sent our way. So there are a lot of opportunities. So our clients that are independent contractors or sole proprietors, they do have options, whether it is the PPP or unemployment. And again, historically, unemployment has not been an option for somebody who's not working for a larger company. So we've been guiding them, and in fact, it just came out, at least in Illinois, that it was finalized that starting on Monday, Illinois will have the portal up and running for independent contractors. And that might be for a client, or it might be the child of a client that was laid off or furloughed, or a family member. So we're trying to make that information available to people who just would never have thought that was an option for them. And, and it's significant. So even if you only qualify for $1 of unemployment from your state, the federal government has added on a $600 a week benefits. So it's significant for people who have, like I said, been furloughed or laid off, or have just seen a significant decrease in their client base due to COVID. And so, yeah, so we have a lot of blog posts out on our website with information on that.
Mm-hmm. Yeah, terrific. Well, maybe we can kind of shift gears a little bit and talk about how, we've all been trying to manage personally, working virtually at home and getting closer to our family. Sunitha, how has that been going for you, for working from home and adjusting to the shelter-in-place restrictions?
Yeah, so first and foremost, I'm just so grateful that my family is healthy and that I have a job that I can make an impact in. Our perspective is a little bit different in that my husband's a physician who treats COVID patients every day, and he has to go into work and see people getting sicker, and there's very little he can do other than just treat the symptoms. So we're grateful if he comes home healthy and if we all stay healthy first. From a work perspective, the transition has actually been really seamless. I've been amazed technologically. It was good in the first place, and it improves so much every week. So no, but just grateful.
Yeah, great. And Jenifer, how about you? How have you been personally adjusting to the shelter in place and working from home?
Well, it's definitely been full days and full weekdays, full weekends, trying to keep up with everything. I think Sunitha can agree that our day jobs have not have not been any lighter. If anything, it's been double and triple the amount of communications with clients, keeping up on all of the new information that's being thrown our way, and deciding how to disseminate that to clients. So it's definitely been full days. And then, you know, we have 5 kids now at home, 4 home from college, 2 of them back from Europe. So all of the drama around getting 4 kids home that weren't supposed to be here, and figuring out how to feed them and, you know, keep the house full of food. And, you know, and then of course there's summer internships getting canceled, and figuring out how people are gonna spend their days, and what's to be next fall. So, you know, a lot of what the rest of the world is facing. So it's definitely, I keep waiting for those moments when I'm going to be able to read that list of books that everyone else is talking about, or, you know, watch those documentaries, and I'm just not finding the time.
Yeah, yeah. Well, it looks like you both have been managing both sides of stress very well. So good role models. So Jenifer, with the shutdown, how has that been affecting your business? And have you seen your business growing over the past couple of months?
Yeah, you know, I think the best part of all of this, from just in the work that we do, is the, you know, this is why we're here. This is why we're serving our clients. And I feel that the level of appreciation and gratitude from our clients for the work that we're doing, for the work that we've done in the past to get them to a place where they can ride out this storm knowing that, you know, they're going to be okay. I think, you know, from that stand, from the relationship of the advisor client, I think, you know, this is sort of the best of times. And so it's been very gratifying to, you know, have clients say to me that I don't have to worry, I'm not worrying about this because I know you're worrying about it for me. And, you know, that's what we're here for. And so, you know, and so it's actually resulted in some new business clients wanting to move, you know, whether it was an old 401k that was just sitting somewhere else, or some other assets that they wanted to move over. And I think it's also, I've started having some other conversations as people begin to realize that might not have that kind of relationship with their advisor, that, you know, it's times like this where you really want to have somebody that you feel like you can turn to, and that's going to be there for you. So yeah, it's like I said, from a business standpoint, it's been a good period of time.
Great. Sunitha, which aspects of the wealth management business do you believe have changed forever?
So I actually think the work from home and video calls with clients are going to be a permanent feature of our future. And I think that's a good thing. It's many more tools in our toolbox to be able to be productive and to enhance communication with our clients. I also believe that with severe market events happening every decade, it's really going to reinforce what Jenifer and I have been talking about the combination of financial planning and investment planning, and the importance of understanding your entire picture when you're building your investment portfolio.
Mm-hmm. Yeah. Jenifer, what lessons have you personally learned during this period?
I think it's definitely been a reinforcement of, you know, never be complacent, you know, and I think, you know, it's easy to, after extended periods of time, to think that, you know, inertia has once again taken over, and, what's in motion is going to stay in motion, and that it's all very predictable. And, the markets prove to us time and time again that that's not the case. But I think this is has been definitely reinforced that, and just been a reminder that, it's really, our clients, investors, the temptation to, sort of that behavioral bias of, when things are going good, I have unlimited risk tolerance, and when things are going bad, I want to crawl into a hole and go into cash. And it's really our job to make sure that, we're sort of keeping a level head and balancing out all of the risks and opportunities that are available to our clients, and really staying true to that. And I think, like I said, this has been a good reminder. We lived through 2008 and 2009, and it's pretty much been 11 years of, letting the good times roll. And this is a reminder that that doesn't last forever.
Yeah. Could be another pandemic right around the corner.
That's right.
I hope not.
I hope not either. Oh, Sunitha, any lessons you've learned?
Yeah, I mean, I completely agree with Jenifer on those points. And I also, it just reinforced that there's nothing like, there's never over communication with your clients. I mean, we were communicating with every single client frequently during the month of March. And I was just so amazed at how many responses I got, even from people who really didn't respond in the past. They were like within seconds of an email, I'd get a response saying thank you. So I do think that clients really look to their advisors for communication, especially during periods of, always communication, but especially during periods of volatility. I think a lot of people might tend to think, oh, well, I don't know everything that's going on, so I don't want to say anything until I know. And I think that clients actually just want to know what you know, and what advice you have for their portfolio. So that was, first of all, over communication. Then secondly, that all of that training we've done on behavioral biases is, you really dust that off and remember it when you're working with clients, because so many clients were basing their view of the markets on the peak of the market after a huge year last year. So just using your understanding of those behavioral biases to frame how you're communicating with clients really, really helped. So really came into play.
Absolutely. Sunitha, what advice do you have for young professionals that are either maybe just beginning in wealth management or that are maybe interested in a career in wealth management?
So my advice is that change is always going to be a part of life. So embrace it and look for opportunities within it. I think this situation is absolutely no different. My boss always says, it's not what happens to you, it's about how you react to it that really will define who you are. So in this situation, learn as much as you can. This is a true historic market event, rewriting economics, rewriting all sorts of things. So learn and read as much as you can. It's a time where your team is really communicating with clients all the time. So do everything you can to think about how you can help your team be prepared. There's going to be a lot of opportunity to do higher level work than maybe you were hired for, volunteer. Even if you're social distance, ask for, regular meetings, video meetings, etc. And, your team's going to really appreciate that because they, like to see people who are putting their hands up. So use this as an opportunity to learn and make an impact.
Yeah, great idea. Jenifer, any additional words of wisdom?
Yeah, well, I would agree with Sunitha that, take advantage of this opportunity. This will define, the kind of advisor, investor you are for the rest of your life. And so make the most of it. Try your best to understand everything that's going on. And it's also a great opportunity to shine. As a young professional, you're typically surrounded by people who know a lot more than you do about most things. And with the environment that we're in, where everybody's on the same page in terms of trying to keep up with the new information that's coming out, and trying to figure out what it all means for our clients. And so so you're on a level playing field with your senior, the other senior members of your team. So take that opportunity to shine and be able to provide information that maybe somebody else hasn't thought of.
Yeah, another great idea. Well, let's go. We do have some questions, so really good questions here. Let's take a couple from our viewers. Do you think the market will dip again to the same bottom, or continue to rebound going forward? Sunitha, if you could maybe take that question.
Yeah, I think that, we do expect volatility to happen. And I think that the depth of any volatility, positive or negative, is going to be related to whether we think there's going to be a second wave, how the next phases of fiscal stimulus answer the state and local needs, and also future needs, because there is more expectation that you're going to see bankruptcies going on further on, and that unemployment is going to stay high for a while. So I think that there's no doubt the market's very susceptible to a hope and fear attitude right now, and news does matter. But I think what's most important is to understand that longer term trajectory of do we really believe that the economy is going to have a slow recovery into next year, and are the possibilities of some sort of better therapies, better preparedness happening, that we can get to a more normal environment.
Mm-hmm. Mm-hmm.
And I would just add that, I think whether we hit the bottom or we'll see another bottom, it's really hard to predict. But again, I agree with Sunitha, we will continue to see volatility. Right now, the markets are sort of, looking through with some optimism that we'll get through this, once we kind of get past, sort of the curve of the pandemic and the realities of what's going on. And my belief is that, we will need another set of stimulus plans to, we kind of, the first round was about creating bridges to get to the other side. And then it'll have to be about, okay, now we have to sift through the rubble and figure out how we can help the companies, the small businesses, the bankruptcies, how do we help them reemerge? So the government will have to come in again and add some more stimulus. And so through all of that, once we kind of get to the guts, the meat of what's going on with corporate America, we'll certainly experience more volatility as kind of the reality of it all sets in.
Mm-hmm, mm-hmm. Sunitha, are your clients seeing or moving towards ESG strategies, or considering those in their portfolio?
So that has been a huge wave over the last several years, and definitely the majority of my clients are very interested in ESG. And actually, Northern, for all of our investment solutions, does look at ESG scores and has that screen in the first place. But yeah, I definitely think that's a trend going forward.
Mm-hmm. You think so as well, Jenifer? What your thoughts? If you've seen that?
Yes, definitely. There's, we've implemented, we have some clients that are 100% committed and are willing to, in their mind, give up returns if, they can sleep well at night knowing that, that their investments are in companies that are, are trying to help the environment. And we've been dipping our toe with other clients that are intrigued by it and, wanting to see how things play out with that. And so certainly this year, ESG has had positive performance relative to its, equivalent.
Right. So question for Sunitha. Is it more or less advantageous to have less liquid or private assets in a portfolio during a pandemic? In other words, you don't see the prices of the private assets fall so quickly like public markets, and maybe clients would panic less. Thanks.
So I think that whenever we look at private assets, especially private equity, the biggest thing to remember is how illiquid they are, because there's such long time frames before your money gets returned to you. So, and it's a call structure. So you're contractually obligated to provide those calls over that period of time. So typically our clients have between 10 to 20% of their portfolio in private assets. So the rest of their portfolio is still moving, and it's just one piece of it. I would say that the role of private equity is really to outperform public equity based on, either manager skill or sectors or, other ways of providing return. So I don't necessarily think that, definitely the performance numbers are muted if you have private equity, but I think that most of our clients kind of knew the private equity environment pre-pandemic, and what they're more asking is, how is this going to affect these very young businesses? Do they have the cash flow to stay in existence? And how much of the portfolio is invested pre-pandemic, because we do think there's going to be a lot of opportunities post-pandemic. So I don't know if it really changed. I don't think it really changed behaviorally how clients looked at their portfolios.
Okay. Jenifer, what are your thoughts on the municipal bond market? Are you scaling down muni bonds and asset allocations due to the risks that states will be unable to make interest payments?
It's a great question, and it's definitely an issue that's come to the forefront in this environment. It's something that, again, has never been experienced, and with the plunge in tax revenues, we are maintaining our exposure to municipal bonds. We think that there could be some nice opportunities there. I do think that the federal government will ultimately come in and help municipalities, state and local municipalities in situations. We all are well aware of what's going on in Illinois. So there will be, it won't be evenly distributed in terms of the kind of help that states receive. But I do, I'm not concerned that, we're going to have a wave of, defaults and bankruptcies of some sort.
Okay. Sunitha, what do you think are the biggest risks to the economic recovery?
So definitely, if there is a second wave and we are unprepared, we don't have the PPE, the testing, the contact tracing, then, we've talked about how we are depending on the government to get us through this until we can find a vaccine and get out of this. And if there is a second wave that is larger than it is today, and we aren't prepared by then that's a risk. Can the government really step in enough at that point? And I think the other risk actually that's less talked about is inflation. So if for some reason we are able to reopen faster, and we do have all this testing and PPE, and the hospitals don't get overwhelmed, et cetera, and we reopen faster, there's a lot of cash that has been injected into the economy. We're already seeing, even from the stimulus checks, fast food sales go up really quickly. You could have people start to spend, and that would drive prices up, and that would then roll into what happens to interest rates, which would then what happens to stock valuation. So inflation is definitely something we haven't seen in a long time, but it's something that we're now starting to put back on our radar.
Jenifer, anything you'd want to add? Any risks that you see in terms of, that would derail the economic recovery?
I don't think I agree with Sunitha. If there is a second wave, or if the ability to get a vaccine takes, or to have find a vaccine and have it distributed takes a lot longer than people are expecting, that's when we could really see a recession that is really prolonged, and whether we're looking at a V or a U-shaped recovery, if we move into that L, it would be those risks that would bring us to that point. And again, to Sunitha's point, that the commitment of the central banks and governments globally to helping their economies recover is really critical. If we did not have that in place, then that's when we look at the real depression-like scenarios. But I do think at least for the large economies in the world, that there is definitely a commitment, and the risk that Sunitha brought up of inflation, which is, the risk that's out there with all of this stimulus, that at this point, the government is willing to take that on, and recognizing that the priority of helping the economy recover far outweighs any inflationary risks.
Sunitha, how many years of ready cash should an investor have based on knowledge of their annual budget and assuming the client has a moderate to low risk tolerance?
So we would look at understanding their annual budget. Then what we do is we would ask the client how many years, looking at prior market events. So the average market cycle is 7 to 8 years, but also the Great Financial Crisis was 13 years from when market prices recovered to their original levels. So I would say it's somewhere in between there, as two cases of, you just want to make sure that you never have to sell your risk assets at depressed levels. You want to make sure that you have enough time of spending to be able to get that market return by being able to stay in the market.
Another question, Jenifer, when will you consider to restart the in-person meeting with clients?
That's a great question. Well, I think part of it is going to be based on what client who the client is, and what the clients are willing to accept. So I would say probably at some point over the summer for younger, healthy clients, that is when I would probably target to start meeting with people in person, to the extent that they're interested in that. Of course, older clients will probably be quite some time. Fortunately, technology has found its way into most clients' homes, and so Zoom has definitely helped in that regard to staying in touch visually with clients. But yeah, it's going to be a kind of wait and see, and each situation as it is.
And I think we have maybe time for one more question. So the 2020 election is only 6 months away. Sunitha, I'll start with you. What are your forecasts for the election, and what are you advising clients to make any adjustments, or in terms of an investment strategy?
Yeah, so coming into 2020, that was actually one of our risks was, and mainly because the policies of the different Democratic candidates were much wider than they are today. And so once Joe Biden became the presumptive candidate, we actually took that off of our risk, our main risks, because it doesn't look like his policies are going to be as damaging to the market as some of the other candidates that could have been nominated had. Having said that, at this point, I think whoever is elected, it's going to be all hands on deck and trying to, from a bipartisan perspective, trying to help the U.S. economy recover from COVID-19.
Mm-hmm. Mm-hmm. Jenifer, would you like to add any thoughts?
No, I mean, I guess I would just add that, I'm certainly not going to predict who's going to win, because that would be foolish. I agree with Sunitha and their assessment that, with Joe Biden as the candidate, we have a more moderate situation. So we're not looking at more of an extreme scenario that could have played out. In terms of trying to position and time the market, I think that it's just so hard to predict, when Trump won the election, there were many investment professionals out there that were predicting the market to really sell off, given the dramatic changes that we would be experiencing and that we were expecting. And instead, after a very brief sell-off in the market sort of took off. So trying to predict how the market's going to react, given a certain scenario, is just really difficult to do.
Mm-hmm. Maintain your long-term strategy.
That's right.
That's right. Well, Jenifer and Sunitha, thank you very much for sharing your thoughts and experiences with all of us. And to our viewers, thank you for joining us today. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. Thank you and have a nice evening.
Thank you.
Thank you.